our camera is not working quite well now, but we will fix that soon. Good morning for those who are attending the webinar in Japan and the rest of East Asia. This is Takeo Hoshi, Director of the Tokyo College and moderator for today's webinar. Today's webinar will be entirely in English, but comes with simultaneous interpretation into Japanese. So if you want to listen to the Japanese, please select Japanese using the interpreter button or tsuyaku button in your webinar application. Many of you have attended Tokyo College events before, but just in case this is the first time for you, let me say a few words on the Tokyo College. Tokyo College was created within the University of Tokyo in 2019, 5 years ago, with the purpose of generating new knowledge to contribute to the creation of an inclusive society. Under the slogan, "Shaping the Future Together," we have been inviting distinguished scholars and intellectuals from various parts of the world and having them give webinars like this. Some of the activities, including these webinars, are supported by your generous contributions. Some of you have signed in to this webinar early and found a new standby screen that contains QR codes. I'm not sure if you have noticed that. And if you scan the QR code, you can reach the website where you can give to the Tokyo College. If you miss that screen, we will show the same screen at the end of this webinar. So if you want to support us, you can just scan the QR code there. I hope you find our webinars valuable and useful, and hope you can continue supporting us. The people that we invite for these webinars at the Tokyo College, they are not only distinguished scholars and experts, but also open to interdisciplinary discussion and serious about public engagement, which is a mission of the Tokyo College. And today's speaker, whom you will see momentarily, is no exception. Professor Manju Puri is a JB Fuqua professor at Duke University's Fuqua School of Business and a world-leading financial economist. She's well known for various important researches in empirical corporate finance, especially on financial intermediation. Her expertise covers a wide area that includes commercial banking, investment banking, venture capital, entrepreneurship, behavioral finance, and fintech. I can go on even more, but today, Professor Puri's talk is titled "From Competitors to Partners: Banks' Venture Investments in Fintech." So I'm sure the topic is of great interest, not only to academic researchers, but also, or more so, to practitioners in financial industry. We have a commentator as well today, as usual. And today's commentator is Professor Kenichi Ueda, a colleague of mine at School of Economics here at Todai. He is an expert on finance and banking, and he's also up to date on the development of fintech industry in general, but in particular, fintech industry in Japan. So I look forward to the discussion today. But now I ask Professor Puri to talk for about 40 to 45 minutes, so we can switch the camera to Professor Puri. And that will be followed by Professor Ueda's comment for about 10 to 15 minutes. For the audience of the webinar, you can write in your questions using the Q&A function on your Zoom You can do this during the talk or after the talk, after we start the session. And I'll be watching Q&A and select some of them to share after the talk and a comment. So are we ready to start now?
Yeah. Can you share your camera?
So let's start.
Video.
So Professor Puri, if you can turn on your camera
Yeah.
and share the slide. Professor Puri, please.
Okay, thank you very much. It's an absolute delight to be able to be here to do this webinar. And without further ado, let me get into it. So today I'm going to talk about banks, investments, venture capital investments in Fintech. And this is joint work with my colleagues, Yiming Kang and Zhang at the University of Connecticut. So let me start out with the motivation for this paper. And the motivation is very straightforward. And that is, what kind of VC investments do banks make and why, right? And so this is an important question. It's not just a topical question, it's been a question I've been interested in for a long time. And so, this is worth thinking about. Now, why does it matter, right? Why should we study bank investments in venture capital specifically? Well, there's a lot of research that suggests who your investor is matter, right? And so the standard way that venture capital is done is typically by a private equity partnership. So these are VC funds with a 10-year life, where the general partners raise money from the limited partners. These could be endowments or pension funds, and then invest the money. And then at the end of 10 years, they pay back the funds with the returns to the investors. Now, banks are very different, right? Banks don't have 10-year funds. So it's typically the bank through either a subsidiary or a department that is making these investments. And so an important question is, does the organization form of the investor matter? Does it matter if you take, as a startup, whether you take money from a private equity partnership, which is the standard, which is the way more than 90% of VC investment is done in the US, or whether you take money from a corporate or a bank, right? And prior research suggests that it actually does matter, right? Why? The incentives of these investors tends to be very different. And so in work that I did when I was at Stanford in the heart of Silicon Valley, right, we actually asked this question 20 years back, right, and said, what's the difference between how banks make venture capital investments versus others? And back then, when I would teach venture capital to the MBAs, I often would have, VC investors come to my class, very successful VC investors from private equity funds. And I would ask them, what's the difference between you're making an investment and banks? And they would say banks don't know what they're doing. We are the real venture capitalists. We know what we're doing. We provide the expertise. We provide the value added. Banks give funding, but they really do very little else. They don't know that much, and they probably shouldn't even be in venture capital, right? And so that was the attitude, and I would listen to them, and I said, okay, I hear you, but this can't quite be right? Why? As economists, we know, that this is endogenous. If you don't have the expertise, you can hire the expertise. So let's say banks don't have the expertise to make venture capital. They can hire, an ex-partner in Kleiner Perkins, someone with the expertise, who will actually then go ahead and make the investment. And so this argument that banks just don't know how to do it doesn't really make much sense. And so in research that we did then, we looked at bank investments in VC in the US. Now, I should remark, the regulation in the US is quite different from that in Japan, right? And so in the US, we had the Glass-Steagall Act in 1933, which prohibited banks from making equity investments in firms. And the Gramm-Leach-Bailey Act of 1999 sort of relaxed some of those restrictions. But there's a loophole in the Glass-Steagall Act by which banks can make VC investments. It has to be in a certain way, either through a wholly owned subsidiary or through the bank holding company. And so for decades, banks have been making venture capital investments in the US. And so we looked at, over the last few decades, now this was 20 years ago, how do banks make investments in venture capital in startup? And what we find is banks tend to be late stage investors. They invest late, in later rounds, they put in more money, they invest in companies more likely to survive. Now, this is very consistent with, my VC expert who would come to my class saying, well, banks aren't doing any value added, they're just giving the money, they don't really have the expertise. But we then ask the question, why? And we find, contrary to the argument that banks just don't know what they're doing, they know exactly what they're doing. Why? What is your motivation if you're a bank? How should you make venture capital? Well, what's your main line of business? It's lending. And so if you're behaving strategically, you should invest in a way that will lever up your main line of business. And that is exactly what banks are doing. They're investing late stage, they're investing in companies that will survive, in industries that take on a lot of debt. And we find these companies are more likely to survive, conditional on surviving, they take out a lot of debt. And when they do, who do they borrow from? It's from your friendly bank who made the investment in venture capital in the first place, right? And so this accounts for why you would invest late stage, why you wouldn't bother about the value added. It's entirely consistent with being a strategic investor. And so we find evidence of this. And now, however, the banking industry has changed. If you look at the competitive landscape in the last 20 years, arguably, the biggest development has been the rise of fintech. And so we said, now it's perhaps time to revisit this question. Now, when banks are making venture capital, how should they do it? And we thought, look, doesn't it make sense for them to change the way that they're investing to meet the fintech challenge? And so that is the motivation. That is what we are looking at in this paper, right? And we're saying, now let's look. We know how they used to invest, but now let's look in the last 20 years. With the rise of fintech, how has bank venture capital investments changed? And you can see fintech, so this is just showing you over the last 20 years, the fintech lending market share has gone from almost 0% to 16%, right? So a massive growth in fintech. So arguably one of the biggest challenges that banks face. And so our conjecture, our hypothesis is that banks, now they're strategic, they're still strategic, but now the focus has changed because the biggest threat is now the fintech challenge, right? And so arguably they should change the way they make venture capital investments to meet the fintech challenge. And by doing so, this can benefit the bank in many ways, right? You get access to the fintech technology. You can, instead of competing for customers, you can cooperate and cross-sell and get other customers, right? And so there are a whole lot of advantages that the bank can have by investing in fintech. And so that is sort of where we're coming from in looking at this question, right? Okay. And so in our investigation, we look at, how has banks' VC strategic focus changed? Has it moved towards meeting this fintech challenge? And if so, what should we find? We should find banks now invest more in fintech firms, but not randomly, right? It ought to be that they increase the venture invest startups
when you have more competition, you're trying to meet the competition. So when the competition is more, your incentive to do things to meet it is more. And then who are you going to invest in? Again, not randomly in any fintech, but fintechs that have complementarities with your own core business, right? That sort of, it makes sense to try and do that. And then we said, okay, then we want to look at ex post outcomes. Do you actually see when they make these investments, what do you actually see ex post? That do you see improved sort of collaborations between the investing bank and the fintechs that they invest in, right? And so that sort of defines the lines of our investigation. And so this paper contributes to in a number of ways, both in the academic literature and for practitioners and regulators. There's a lot of interest in, how do banks adapt to changing financial markets? Because surely the last 20 years have been a massive era of change. Then what about banks' investments in fintechs? And then there's a big literature just on fintech or not, right? And so it contributes in a variety of ways to all of these literatures. Now, how do we go about doing this study? We need data and we need a lot of data. So I'm based in the US, so this study is very much based in the US. And so we first need fintech startups and their financing information. So we get that from Crunchbase. Our sample period is literally the last 20 years. So from 2001 to 2022. And we're going to look at equity deals of US-based VC startups. Now, we also need to know who is a bank. So how do we know that? We look at the call reports. These are done by the Fed, so these are very official. And we do a fuzzy name match from the call reports to the investors in Crunchbase. We manually check this to make sure that, we know which investors are actually banks. We then collect financial information from CompStat and stock market information from CRISP. Now, because one of our hypotheses is on the fintech competition, we need to be able to measure fintech competition. Now, it's been well documented that one of the big areas in which there's been a lot of competition is mortgages, right? And so in the US where I am, if I'm buying a home and I want a mortgage, 20 years ago, I go to my neighborhood bank. Now I'll Google online, look at everyone offering mortgages, try and figure out who's giving me the best rate. And so fintech has made a lot of inroads there. So we're going to use the public HMDA data on mortgages to sort of help us measure fintech competition. And I'll talk a little bit more about that. And then we want to see, after you've made the investment, what happens subsequently? Do you see operational collaborations? This is really very, very hard to quantify because we don't have any database. So my co-authors and I spent a lot of resources in basically hand collecting this data, scraping the web, looking at the websites and Google News Search to look at, bank fintech pairs. Do you actually see collaborations? And if so, what is the nature of those collaborations? Okay, so let me get into the sample. So the sample is first, we start with fintech startups. Again, we're using Crunchbase, which has,
801 industries, 49 industry groups. We're going to classify 7 fintech spaces based on Crunchbase data. These are going to be payments, bank and lending, wealth management, crypto-related, exchange and trading, AI, cloud and IT, and others. Now, who is a bank? A bank is going to be either a public bank holding company, because remember, you can make investments through the bank holding company, or a bank who invests through a wholly owned division. So in the US, that might be a Section 20 sub, or think of it as a corporate sort of VC arm of the bank. So again, we're looking over 20 years, and what we find is there are 51 banks who participate in 475 financing rounds of 323 fintech firms. And that's going to be our core sample. Let me just show you a time trend, right? And so this is a picture of bank investments over time. And if you look at the dotted red line, that is all investors investing in fintech. Now, you might say, well, fintech has grown, everyone is investing more. not just banks. To some extent, that's true. But what we see is banks are disproportionately investing more. So if you look at other investors, the fintech investment goes up from 7% to 34%. But for banks, it goes from 20% to 70%. So there's a big increase. The bulk of banks' VC investments is now 70% into fintech as opposed to 20% 20 years ago, right? If you look in terms of financing rounds, you see a very similar picture. The dotted red line is giving you other investors. The solid yellow line is telling you banks. So you can see again, there is a disproportionate increase in investment in financing rounds by banks. So if you look at all investors, fintech deals in percentage that they invest go from 4% to 15%. For banks, it goes from 4% to 35%, right? So it's more than twice that of other investors. So this just establishes the basic facts that banks are indeed doing a lot of venture capital investments in fintechs. And if you look at the cumulative number of fintech firms that banks are invested in, by the end of our sample period, 2022, 51 banks have invested in 323 unique fintech firms. Okay, so now we've established banks are indeed investing disproportionately in fintech. The next question is why so? Right? What drives banks to invest, right? And so we have what we call the treatment group, and this is where banks have actually made the investment. We now want to compare that to a control group where banks have not made an investment, right? To try and see the differences between the two, to try and understand, why are banks doing such investments? So how do we create a control group? So the actual treatment group is very straightforward. It is when banks are investing venture capital in startups. So for the control group, we do a couple of things. We create what we call pseudo deals, right? So these are false deals. They haven't happened, but we're going to pretend they happen, right? And so for each actual investor, we'll have 5 pseudo investees. So we will take 5 fintech firms that got financing in that year, but not from a bank, right? And use that as a match. And we'll take each fintech firm that got money and match it with 5 pseudo investors, right? And so so this fintech firm got money, but not from banks, right? And so we're going to match it with 5 banks that it didn't get money from, right? And so this is going to be a controlled sample, and we're going to compare and contrast the two to try and figure out what's going on. So we're going to make 2 control samples following the literature. So one is just a random control sample. So for each actual deal, I'll have 5 pseudo deals that I'll draw randomly from the pool. And this is fine, but I think the stronger measure is number 2, which is what we call propensity score matching. Here, what we do is we try and make sure that the matching is a little closer, right? So we match the firm age, we match the financing round for the firms, and for the banks, we match on bank size and book to market. So the match is a little closer, it's a little tighter. And I personally like number 2, right? Because the match is closer. And so the results that I'll show will be for number 2. All our results will hold even if I just do number 1. Okay, so let's look at fintech competition and bank investments, right? So one of our hypotheses is that the greater the fintech competition, right, the more banks are likely to invest in fintech. Okay, so how do we measure fintech competition? Well, we know, thanks to the work of other good academicians, that where have fintech shadow banks really made a big dent? It's been in mortgage, right? And so we know mortgage lending is now, a very large share is done by fintech. And so we're going to measure competition, right, in the mortgage market, right? And we're going to use the share of fintech in the mortgage markets as our measure of competition. So we're going to compute the growth rate of mortgage loans originated by fintech lenders in a given county and year, so by geography and by time. And then remember, banks have branches all over, so I'll need to weigh it, so, Bank of America may have branches in many, many places, right? So I'll need to aggregate, across all those branches, weigh it by the growth rate and aggregate it back in order to sort of measure the competition. Now, this is just a picture showing you the fintech lending share across states in 2020. And the dark blue is where you have more competition, and you can see, California, New York, the natural subset, suspects, more competition. We next look at growth rates. And, so where is the growth rate highest? And it's where you would think it would be, California, and then on the East Coast, New York, Virginia, Massachusetts, they tend to have higher growth rates. Okay, so now that we've established this, we're going to look at, where do banks invest? And for me, I found these results interesting because remember, I had studied this, 20 years ago. And I find at one level, the patterns of investment are similar. Banks continue to invest late stage. So this is just showing you, bank investments in early versus late as compared to others. And you can see banks are investing late stage. They always did that. They continue to do that. And you can see they also tend to invest in larger deals, right? And so banks have maintained their way of investing at this level, which is you invest late and you invest in larger deals. Okay, however, they are now investing in fintech, right? And where are they investing in fintech? So we have 7 subgroups, and you can see banks have greater preference for investing in payments, bank and lending, and AI cloud and IT. Okay, we now look at, does fintech competition matter? So I'm going to run regressions. My left-hand side variable is going to be, does the bank actually invest in a fintech? And on the right-hand side, I'm going to control for a whole bunch of things, including having lots of fixed effects. For my purpose, what is important is what you see in red, right? And that is, the more the fintech competition, the more likely is the bank to invest in a fintech startup, right? And so this is what we hypothesized, and that is certainly what you see in the data. Okay, the next thing we're going to ask is, what kind of fintechs are they investing in? And for us, it made sense you would invest in fintechs that are complementary to you. Now, how do you measure that? We're going to use 3 different measures, right? And each measure it's not going to be perfect, but each measure is going to capture different things, and you're going to see they all sort of sing the same song. So the first is we're going to look at the technological relatedness between the fintech and the banks based on their patents. And we're going to follow the literature. We're going to use Jaffe's measure of technological overlap, which is essentially the cosine similarity between the technology classes spanned by the 2 firms' patents. So intuitively, what are we trying to do? We're trying to see how close are the bank patents to the fintech patents. The argument being that if they're closer, then the bank has a bigger incentive to invest in those kind of fintechs. The next measure we're going to look at of technological relatedness is how often do you cross-cite each other? So how often does the bank cite the fintech's patents? Or how often does the fintech cite the bank's patents, right? And so we're going to look at cross-citation of either one of the measures, cross-citation by the bank, cross-citation by the fintech. And obviously, we're going to restrict it to patents granted before the investment is made. A third measure is going to look at business relatedness, right? And what we're going to try and see is, does the business of the fintech and the bank overlap? And the way we do this is by keyword search. We look at the business description of the fintech, the business description sort of the bank, And we see how many keywords sort of overlap, both in terms of an absolute number and as terms of a percentage, right? And so we'll use both those measures in trying to see that, right? And so we'll have these three measures of technological as business relatedness. And then we're going to see, do they matter? So again, we'll run regressions. On the left-hand side is, do I, actually invest in this deal? On the right-hand side, all these control variables, what is important for us is the line in red, that if I have more of a technological overlap, as defined by my cosine similarity between the patents, then you find there is a bigger incentive that, yes, banks are indeed more likely to invest in such fintechs. We next look at the second measure, which is cross citations, right? And say, if you have cross citations, the bank citing the fintech or vice versa, do you see the bank actually making more investments? And the answer is yes, you do, right? Now, one thing that is interesting is when we split it up by citation by bank and citation by fintech, what we find is the significance really comes by the fintech sort of citing the bank, right? So another way of thinking about this is the fintech is building on the intellectual sort of patents or developments by the bank, right? So the bank did something in a technological space, the fintech took that and extended it forward. Those kind of fintechs, the bank is more likely to invest in. And the third measure was, is there an overlap in business? And remember, we're taking keywords, both number and percentage. And what we find is, again, the answer is yes. The greater the overlap in business, the more likely is the bank to actually invest in these fintechs. Okay, so now we've established banks invest heavily in fintechs, not randomly. They're investing when the fintech competition is higher, and they're investing when there's complementarity in terms of technology and the business between the bank and the fintech. The next question is, how do banks actually benefit from these investments in fintech firms? Now, this was actually hard to measure because there's no database. So we spent a lot of time scraping the web, looking at the fintech websites and the bank websites to try and figure out collaborations. And so we put this together, and then we define the collaborations in three ways. Is there a fintech bank partnership in terms of using the financial technology? So that is, the bank is using the fintech technology in some way? Or is the fintech sort of cross-selling to the bank? Or is the bank sort of cross-selling to the fintech? So let me give you some examples of each. So fintech bank partnership, when you use the fintech technology. So an example is Live Oak Bank makes a partnership with Defense Storm and then uses Defense Storm cybersecurity and cyber compliance for fraud protection. So you're using the fintech technology to help the bank. The second is you're cross-selling to bank customers. So American Express, for example, offers its card members statement credits of $2,000 if you originate a confirming mortgage loan through better.com, right? The third is cross-sell to fintech customers. So Sterling National Bank, for example, participates in an initiative of a finance app. So Goalsetter has a finance app on bringing financial education to the next generation. And so Sterling National Bank is saying, okay, we'll give savings accounts to 1 million students in minority communities by sort of tying up with this fintech. So now you're cross-selling to the fintech customers. Okay, and so this is showing you, how often do you form a collaboration? And you can see this, the numbers are massive. If a bank invests in a fintech, more than a quarter of the time, 27% of the time, they form a business partnership ex post. Now, if you don't, those numbers are like 2%, right? And so this is massive. right? That if you just randomly were to collaborate with a fintech, what are your chances? Very low, 2%. But if you made that investment, your chances are 27%, very, very high, right? And this is just saying, you know, it's largely, the biggest amount is using the fintech technology and then cross-selling to bank customers and then cross-selling to fintech. Okay, and in which areas we find the partnership is highest in AI, data, and IT, least likely in trading and exchange, and
Selling is most likely in payments and bank lending. It's very intuitive. If you think about it, that's probably
what we would have expected, and the data is confirming that. Okay, and then as economists, we always want to ask, is this actually causal or is it just correlations or associations? Yeah, you find banks are investing and you see this, but you know, is there actually a causal relationship? And a lot of economics is, you know, and Nobel Prizes have been won for this, right? Trying to establish causality. And so we're going to follow the tradition of economists in trying to do this using an IV or an instrumental variable. So that is, look at another variable that is correlated with the broad phenomenon, right? You know, so in this case, we're going to take, you know, how big is the bank's local market share? So if it's big, you're saying, okay, then there's more funding availability to fintechs in general, but that doesn't mean that any one particular fintech is more likely to get the bank investment. So we use that as an instrument, and you know, and so we have our first stage, which is nice and significant, and then what you see in red is the significance when we use the instrument on, do I have a partnership ex post? And you can see it's very significant, particularly, you know, for the use of fintech technology. And again, it's also significant for price citations. But the interesting thing is, you know, remember when banks are investing in fintech, they're more likely to do this when the fintech is citing them. But ex post in the partnership, we find now the bank is more likely to cite the fintech. So this is consistent with the bank is now using the fintech firm's knowledge after it's put the investments in order to do its own innovation. We do many robustness checks, which I'm not going to go through. You know, I told you I had a random sample. We'll look at other IVs. We'll control for various things. We find very, very similar results. So at this stage, let me conclude. So what have we done? We have looked at the last 20 years, and we have looked at banks' VC investments, and we find there has been a rapidly increasing trend of banks making investments in fintech startups. So banks' venture capital investments have always been strategic. They continue to be so, but in a different way from the past, right? So 20 years ago, banks were doing VC investments to lever up their lending business. But in the last 20 years, with the growth of fintech and the fintech challenge posed by the fintech competition, banks have started doing VC investments differently. They're investing in fintech when they face higher fintech competition, and not randomly, but in fintech startups that have a higher business relationship or a higher technological relationship with them. And why so? What is the benefit to the bank? So when we look ex post, we find these banks' venture investments are resulted in an increased probability of operational collaborations and in a knowledge transfer between the investing bank and the fintech investees, right? And so this is telling you, you know, the financial world is very dynamic. There are many, many changes, and banks are adapting to these changes by changing the nature of fintech investments. So that concludes my lecture. Thank you.
Okay, thank you, Professor Puri. And now we turn to the commentator, Professor Keiichi Ueda. Professor Ueda, are you ready?
Yes,
start?
I think so.
Okay, please go ahead.
Oh, thank you very much, Professor Puri, and this is a great paper. I have to say, first of all, not so familiar with economics literature and economics science. I would like to say that one of the roles of economics is that when people talk some casually about, in this case, like looks like banks are kind of their role is shrinking because of fintech, or maybe that's because banks are looks like buying fintech companies, and those casual talks we often hear. And then one of the role of economics is to identify the truth, what's actually going on. And then, of course, Professor Puri's case, and even more deepen the understanding of what's really going on in this world. So this paper is quite successful with especially using very meticulous collection and construction of data. Really congratulate this paper success. And then in general, I just behind the scene, as I said, and people are talking is about banks, whether the banking or the banks as a whole is somewhat obviously confronting some challenges from fintech service. And then the question here is like, before in the old days, I'm also old, in a textbook description of bank, why banks exist? Banks to collecting deposit and lending loans to companies and households, and then also at the same time providing payment services. And everything we usually explain, and banks tend to be big. Everything usually we explain something called economy of scale and economy of scope. Scale is meaning that if getting bigger, it's cost per customer getting smaller, so that the banks tend to be big. And also economy scope is that the deposit activity and lending activity and payment service provision looks like customer base is kind of overlapping each other. And everything can be done by a set of banking experts at the same time, so that making those function together makes sense. And that's kind of our old understanding of banking industry. And obviously, fintech started to challenge this kind of concept, so that the fintech, so the similar fintech, of course, one of the lending specific one, especially mortgage lenders. And then there are a bunch of payment service provider, sometimes called payment fintech companies. And then there are even more kind of fundamental one, I would say, blockchain-based cryptocurrency kind of those guys. And then there are several, of course, there are lots of things. Something that is not kind of related to fintech. Well, it is a fintech, but its main target is more like providing cloud server services, which banks borrowing or another finance service providers borrow or have. And those are not really a fintech, but it's really very related to financial service. So that sometimes we do see, especially those service providers specialize in having lots of customers from financial services. I would say it's kind of gray zone fintech. But anyway, those I believe those services are all covered by Professor Puri's study. But the question I have to say is that where this so-called economy of scale, economy of scope based explanation gone? Why it's gone? And then that's also related to, I believe, somewhat to this study, I believe. One is people, one way is, I do believe economic scale and scope is still there, but somehow it is weakened. There are one kind of people saying also, which I would like to know if it's true or not, is a tightened regulation, especially after global financial crisis of like 28, 9, that time. The tightened regulation every year culminated as Basel III, called Basel III, newer kind of regulation all over the world, especially targeting banks, big banks, and also big insurance and investment bankings. And that, and at the same time, it is also increasingly government ask banks to scrutinize customers based on anti-money laundering and combating the financing terrorists called AML, CFT screening. And those I had both regulatory, typical regulation as well as AML, CFT regulations kind of. We ask those big banks, usually traditional banks, quite a lot. And that's also that regulation only for this typical traditional banks. That's why sometimes we hear that fintech, smaller company and specialized company doesn't have to really pay those costs. That's why they become more profitable than traditional banks do. If that's true, part of this fintech is kind of just a regulatory arbitrage. And another one is more, I don't know how to say it's a fundamental difference between a traditional bank. Well, I and Professor Puri kind of this financial economics typically wear these suits because customers are not customers, samples, samples, we talk a lot with bankers and finance people. Traditional guys usually wear these suits, while fintech people actually t-shirt and jeans. And I also talked with one entrepreneur, Japanese entrepreneur, who created a finance service fintech company and recently exited by, by successfully exit by selling to other company. But anyway, this guy said one of the most difficult thing is to have to hire traditional bank experts and fintech software programmers. Those wear different things, and not just wear different clothing, but the culture is completely different. So that may be another reason why the banks, and the question is, if the banks still have economic scale and scope, I would say those fintech services should be emerge inside the bank, or the banks themselves should do, but somehow not. So the question is, one explanation may be just the regulatory thing. Another explanation maybe it's indeed it's completely culture. In that case, we should keep these entities separately, which I don't know how to analyze. That's something I want to know in a more deeper sense. Why we have a kind of separation of those things coming up in that sense. And then maybe I have smaller questions maybe later on, but anyway, that's one big question. But if you have any thoughts on this.
Thank you. You're continuing.
More like minor, maybe I should answer the minor, one or two minor question. Why is that? Okay, the minor, very minor question. I just kind of puzzled because you talk about 51 banks at your sample, which I quickly Googled, and then in US there's 4,200 FDIC backed banks and about 600 public credit banks. 51 bank seems small. that's how you interpret your result is one. And then another one is this is also more like a casual thing. I just saw the fintech this map where the fintech is growing. It looks like this color looks like very resembling in presidential election, which maybe that's not really you cannot talk, but anyway, that's my small comment.
Okay, so thank you, Kenny. And at this point, I'd like to ask audience to
Can I respond?
write in a Q&A and we get discussion. And Professor Puri, can you respond?
Yeah. Thank you very much for that discussion and for raising a number of interesting points. Let me start with the last one because I have a lot to say about the first one. So the last one, why do we have 51 banks when we have some 6,000 banks in the US? And the reason is, there's a lot of heterogeneity in the US. Many of those banks are small. So if you actually look at the banks doing venture capital, there are more 70 or 75 banks are doing venture capital. Small community banks don't do venture capital. And so we are looking at, the bulk of VC investments in our sample for sure. The first question, which I think is actually a very interesting question, and that is, you raise, given economies of scale and scope, why shouldn't a bank just not integrate everything, right? And then you also raise the specter of regulation. And I think that is exactly right. There's regulation, there is concern on so many fronts, right? On, do we want banks to be too big to fail? And, and this is the reason why, in the US, they traditionally separated lending from equity investments and everything else. And so there is certainly regulators are concerned about banks becoming so big through integration of becoming too big to fail. There is another aspect too, which I think is interesting. And that is when we think of fintech, right? What do fintechs do that are different? Now they use technology. So I have actually quite a bit of work on fintech. And one of the papers that we did was we actually took a large fintech in Europe that sells furniture, right? And we got data from them. And we asked a very simple question. And that is when as a customer, you go to the website, you browse, you say, maybe I'll buy a coffee table or a lamp. And then you go, how much information do you leave behind? And it turns out you leave behind a lot. Simply by going browsing and maybe buying a lamp and coming back, we found you leave as much information as your credit bureau score, right? Massive amount. And I'm not talking of accessing Twitter or Facebook or any of that. So this is just, how do you access the web? Do you have an iPhone? Because the wealthiest people have iPhones, so that's a proxy for that. What time of the day do you shop? People who shop between midnight and 6 a.m. have the highest default rate. They tend to be impulse shoppers. And so just very simple variables, right? Without, what we call a shallow digital footprint. So I'm not asking for your mobile phone. I'm not asking for your social network. And yet, we can predict default, with as good probability as a credit bureau score, right? And so when we look at fintech, there's a lot that they can do that banks have not traditionally done, right? You can use digital footprints, you can use social media, etc. Now, but when I talk to banks, right, banks are very hesitant using all of these. Why? They're heavily regulated. The examiners will come. We don't know, how good are these measures in downturns, right? In upturns, they might be fine. And so you can see regulators or examiners saying, really, you're making this loan based on what time of the day the guy shopped? Does this make sense? Is it going to stand the test of time? And so it can be very difficult for banks to fully use the fintech technology because banks are fully regulated. And one of the things we thought we would see when we first went to the data was that banks make investment in fintechs, and then we said, okay, maybe they'll acquire them. They don't. There's next to zero acquisition of banks in fintech. When you think about it, it makes sense. It makes sense to have a collaboration. Once you acquire a fintech, they are a bank. They are subject to the same regulation, right? And so this really does point to, we want to use the technology, but not run afoul of other things. So I think it's very consistent with that intuition.
Okay, thank you. Here's a good question from the audience, which is actually something I not expected. Let me read the question. Are there any comparable studies of bank investment in fintech in other markets, like London or Tokyo? And are there obvious differences in practices and trends from the US market?
I think that's a very good question. And the answer, as far as I know, is no. There aren't any studies. I think even in the US, I mean, we're the first to do this study, right? And it takes a lot in terms of data gathering and everything else to do it. And so a lot is a function of how much data is available, how much are the regulators. Very often the data is with regulatory authorities. So, is it available? Can people work with it? And in the US, we didn't get anything from regulatory authorities, but there are, a lot of data providers that are putting together data from startup and others. But we had to do a lot of work, including a lot of manual searching of the web in order to do this. So that is a big barrier. And, I'm hopeful that other people will do those studies in London and Tokyo, but it hasn't happened yet.
Do you know any studies about the Tokyo market in Japan?
I don't really know the study, but I do the same type of trend is really, I think, developing in Japan too.
Oh, okay, but you don't know.
I don't really know the systematic study.
Or empirical study. Okay, so that's a good news for
us.
For us, and also economists or the people who are interested in especially in the audience. There's a room, there's an opportunity for new findings, new studies. So, including the person who asked this question, you're encouraged to look into that. Okay, and we will continue to get questions from the audience. But while I wait for other questions from the audience,
what thing I would like to add is that in Japan also the regulation is a big issue.
okay.
And I believe it's like Glass-Steagall here. It's usually banks cannot really invest in non-financial, but only through the holding company funds. However, the two exceptions, one is very recently, 2 years ago, so the smaller local banks, smaller regional banks only, they are started to allow to invest in non-financial corporations. So we see what's going on. And then another one is, unlike in the US, non-financial corporations can set up banks. Like Sony have a bank, and then Ion Group, which is kind of Walmart here, have a bank, which is really different. So that was another little bit different state here, but which is also, I think, created very interesting place to see on home in the future.
So just related to this regulatory difference, both of you mentioned bank regulation may be limiting the advancement of the banks into a fintech directly. And but there's some good rationale for banking regulation from a financial stability point of view of the economy. So my question actually to both of you is, what would be the implication for financial stability of this trend of banks investing in fintech through their venture capital arms? I haven't thought about these, but I need to think about, is there any serious financial stability implication that the regulator should worry about? So in a sense, the banks may be acquiring these fintech companies in order to get around some regulations. What do you think?
So I think what we're seeing is banks do not acquire them, right? So I think the concern on financial stability would probably be a lot higher if banks did outright acquisitions of fintechs and embrace them. We do not see that in the data, and I think this is indeed probably because of regulation. I don't think banks are thinking of financial stability, but they are thinking if they want to use everything the fintech has, they might be better off with a collaboration rather than acquiring it and making the fintech a bank. And I think if you have operational collaborations and they're cross-selling, those effects are definitely muted.
Yeah, my sense is it's also regulators know about this. So they actually try to expand their power. They try to reach out to those non-bank financial institutions or fintech, including fintech, so that especially AML side, they try to raise the regulation to those places. So some of the fintechs kind of receiving kind of benefits may be eroded by the tightening of those regulations. That's the one. But the financial stability side, AIM safety is not really financial stability. Financial stability is like bank capital requirement of those things. Those things I think still remain probably lower to smaller fintech places. But however, at the same time, it is increasingly, at least my personally, it's a bit, at least in Japan, I have some feeling of anxiety of when our regulators allow smaller banks to start investing any non-financial industries. They starting like supermarkets, they start to buy like real locally. That I feel anxiety because of financial stability that we have to figure out.
So that's something you would worry about even more.
That's not fintech, it's totally unrelated industries. I see Japanese local banks start to invest. But then fintech is kind of related sides, which I think it makes sense. There's some synergy definitely as the first positions.
So I think in the US, there are much stricter regulations on banks, of non-banks acquiring a bank and vice versa. I think Walmart applied at least twice for a banking license and was denied. So I think, yeah, the regulation is also quite different between the US and Japan.
Ask another question while I wait for more questions on the web, on the Q&A. So you find the banks investing in these fintech firms, although they don't acquire them, but they invest through venture capital arms and so on. So these fintech firms they are investing are the potential competitors of the banks, right? And that's probably the reason why they invest in these fintech companies. So that may be good for banks and fintech firms, but how about consumers who use financial products or financial services provided by banks and the fintech firms? Wouldn't the bank's collaboration with the fintech firms reduce the competition and hurt the consumers?
That's a good question. I can see it going both ways. I mean, it would require another study to actually study the market concentration, because you have to do that from the other end, right? You have to do it from consumers, looking at financial competition. You'd have to develop some sort of measure of market concentration, which includes non-banks. Historically, concentration measures have been for banks, right? And so the jury is out, is what I'd say, because it hasn't been measured. I think in theory, it can go both ways, right? So one is the market might get more concentrated. The other is, as a consumer, you actually have more choices. You have one-stop shopping. And so now you have all these things that you may not have done and that you would do, right? So I think people have argued, that even like investing in the stock market or mutual funds, if you make it really convenient for people so that now they can do it from their bank account, you can, they might start actually accessing more services. So I think you could see many effects, maybe some positive, some negative, where it ends up. It's all a question of, where the weight falls.
Yeah, I also want to see more research on this, because it's very interesting that Professor Puri showed that banks typically invest kind of later, not really the first money, but in a later, once fintech companies become, I believe, somewhat successful, then they are willing to invest. That means it's a kind of, those guys that in the end try to go IPO and try to make money, but it takes time. So before that, sometimes they want to know some kind of mid-term result in a sense. That maybe this bank's investment that is also creating some kind of signal, also some kind of reward as a mid-term kind of exam. In that case, I think it's maybe not just financing, but some kind of incentivizing fintech companies to grow more, or their competition maybe even in a better kind of become better competition. Kind of that's my feeling. But of course, I think it's very interesting kind of hypothesis to look at. But do you have any thoughts on how this late VC, what does that mean compared to the past VC? Yes.
So so I think this is an interesting observation. Why do banks invest late stage? Because they want the survival probabilities to be high, right? And so, if you're in the business of investing in fintech, so you can have these business collaborations, you don't really want to invest very early stage. And that is exactly sort of what you're seeing in the data. These are fintechs that, are probably pretty far along in terms of success in their products. And the banks feel that, something here is material. So I think that is true. I think related to that, and again, more research is needed, right? Are these collaborations exclusive? Or, like, suppose I'm using your technology to prevent fraud. Am I stopping you from selling it to other banks to prevent fraud, right? And we don't know that. You really need data on the underlying contracts. But intuitively, if it's fraud prevention, why stop them? If it's cross-selling, I can see, you might want to say, hey, just cross-sell with me, right? But so I think, the answer, as usual, is it depends, right? Yeah.
Well, thank you very much, Professor Puri, for sharing the new insights or new findings of your study, and also thank Professor Ueda for excellent comments. And we all need further research. So this is a good news for researchers in the audience. Please think about these findings more and try to look at these issues furthermore. The Professor Puri point to some of the future discussion or future inquiries that we can make. So please take those up and look at the similar issues in Japan as well. So today we have managed to answer all the questions, which doesn't happen very often. So we would like to close here. Thank you, Professor Puri, and thank you, Professor Ueda. And I promise I get back to the screen later about how to give to Tokyo College. So if you can, if we can have the screen up again, I can show that to the, okay, here we go, to the audience. So thank you very much for participating, for looking at this webinar. And we are finishing up this webinar. But as I said, our activities, including these webinars, depend on the public support, like yourself. And these are the places that you can go. You can follow the QR code and find out how to support the Tokyo College. So I ask everyone for continued support for Tokyo College, and this ends our webinar. Thank you very much.
Thank you.
Thank you very much.